For value investors, the quest for stable, high-yield investments often leads them to companies that can weather market storms while providing consistent returns. UnitedHealth Group, UNH, is one such company, but recent challenges have raised questions about its dividend reliability. Is it still a solid bet for long-term investors? A legacy of steady dividend growth, UnitedHealth Group, a behemoth in the healthcare insurance industry, has a storied history of rewarding its shareholders. The company has increased its dividend for 34 consecutive years, earning it a prestigious spot among the dividend aristocrats. Over the past 5 years, from 2020 to 2025, the quarterly dividend payout has more than doubled, rising from $1.08 to $2.21 per share. This impressive growth reflects a compound annual growth rate, CAGR, of 16.1%, a testament to the company's financial strength and commitment to shareholder value. The dividend's consistency is even more remarkable given the volatile nature of the healthcare sector. UnitedHealth's business model, which relies on collecting premiums and managing medical costs, has historically helped it navigate economic downturns. During the 2020 pandemic, when healthcare demand surged, the company maintained its dividend schedule, making adjustments in February, June, August, and November to ensure financial discipline. Chapter E: Earnings Volatility and Analyst Concerns. However, the landscape changed in Q2 2025 when UnitedHealth reported earnings per share, EPS, of $4.08, falling short of analyst expectations by 8.31%. The primary culprits were rising medical costs in Medicare Advantage and Medicaid programs, coupled with operational inefficiencies at its Optum Health Services unit. These issues pushed the medical care ratio to 89.4%, a significant increase from 85.1% the previous year, squeezing profit margins. Analysts have responded with caution. Morgan Stanley's Erin Wright lowered her price target from $374 to $342, while Baird downgraded its rating to sell with a target price of $198, suggesting a potential 24% downside. Despite these concerns, the stock currently holds a moderate buy consensus rating, with 15 buy ratings, 6 hold, and 3 sell from 24 analysts. The average price target of $366.52 indicates a 40% upside, but the wide range of targets from $198 to $700 highlights the uncertainty surrounding the company's near-term performance. The high-yield dilemma. Amid the earnings turmoil, UnitedHealth Group's dividend yield has climbed to 3.5%, a level not seen in decades. This increase is partly due to a 50% drop in the stock price in 2025, making the stock appear undervalued relative to its historical multiples. For income-focused investors, this presents an enticing opportunity, a high yield backed by a company with a 34-year track record of dividend growth. However, the higher yield comes with risks. The trailing 12-month TTM payout ratio has risen to 50.6%, a significant jump from the 10-year average of 29%. While this ratio is still below the 60% threshold, often considered a red flag for dividend sustainability, it raises concerns about the company's future flexibility. If medical costs continue to rise or earnings growth stagnates, UnitedHealth may face pressure to either cut dividends or raise additional capital, potentially triggering a sell-off. Strategic resilience and long-term potential. UnitedHealth Group's management is aware of the challenges and is taking proactive steps to address them. Initiatives include leveraging AI for cost reduction, tightening pricing discipline, and strategically exiting underperforming markets. These measures aim to stabilize margins and rebuild investor confidence. The company's robust free cash flow of $24.9 billion over the past 12 months provides a buffer, enabling it to return $7.7 billion to shareholders through dividends and buybacks. For value investors, the critical question is whether these strategies will pay off. UnitedHealth's long-term growth drivers, such as aging demographics, the expansion of Medicare Advantage, and the digital transformation of healthcare, remain intact. If the company can effectively manage its medical cost trends and improve operational efficiency, its dividend could resume its upward trajectory. Investment considerations. UnitedHealth Group's current valuation offers a compelling risk-reward profile for patient investors. With a forward P/E ratio of 13 and a dividend yield of 3.5%, the stock appears undervalued compared to its historical averages and peers. However, the risks are real. A high payout ratio, a debt-to-equity ratio of 75.6%, and ongoing legal controversies, such as lawsuits against critics, could exacerbate volatility. For investors willing to tolerate short-term uncertainty, the stock may represent a contrarian opportunity. A diversified portfolio could allocate to UNH as a high-yield, defensive play, provided investors closely monitor earnings reports and management updates. On the other hand, risk-averse investors might prefer to wait for clearer signs of margin recovery before committing. Conclusion. UnitedHealth Group's dividend stability has long been a cornerstone of its appeal, even as earnings volatility becomes a new challenge. While the current environment introduces uncertainty, the company's strong balance sheet, long-term growth drivers, and disciplined capital management suggest the dividend remains secure. For now, for value investors, the key is to balance the attractive yield with a realistic assessment of the risks. In a market where high-quality income opportunities are scarce, UnitedHealth Group stock may yet prove to be a resilient addition to a well-constructed portfolio. But here's where it gets controversial. Some argue that the company's high yield is a warning sign of underlying issues, while others see it as a buying opportunity. What do you think? Is UnitedHealth Group a safe bet, or are the risks too high? Share your thoughts in the comments below.